Have you ever wondered how to trade gold or other currencies like the euro or USD? Welcome to the world of trading, a dynamic and potentially rewarding landscape where knowledge is power. At its core, trading is about buying and selling assets such as gold or currencies with the aim of making a profit. Let's take gold as an example. The price of gold fluctuates constantly, influenced by a myriad of factors from economic indicators to geopolitical events. Traders buy gold when they believe its price will rise, selling when they think it will fall. Currencies operate in a similar way. Consider the euro and the USD. Their exchange rate is in constant motion, driven by economic circumstances, political events, and market sentiment. Traders buy a currency when they believe its value will increase against another, and sell when they expect it to decrease. The world of trading is vast and complex, but don't let that intimidate you. Grasping these basics is the first step towards successful trading. Now you might be asking, what are ETFs? Well, allow me to shed some light on that. ETFs, or exchange-traded funds, are essentially a basket of securities that you can buy or sell through a brokerage firm on a stock exchange. They are designed to track the performance of a specific index, sector, commodity, or asset class. Imagine having a mini portfolio that encapsulates a particular market theme or strategy. That's what an ETF is. Now, why are ETFs such a big deal in the trading world? What makes them so attractive to traders and investors alike? One of the key reasons is diversification. Rather than putting all your eggs in one basket by investing in a single company's stock, ETFs allow you to spread your investment across a wide range of companies. This way, if one company underperforms, the others in your ETF could potentially offset the loss. Another benefit of ETFs is accessibility. Whether you're interested in technology stocks, international markets, or even the gold price, there's likely an ETF that suits your interests. They provide a straightforward way to gain exposure to a wide variety of asset classes. But it's not all sunshine and rainbows. As with any investment, ETFs come with their own set of risks. While the diversification of ETFs can protect you from company-specific risks, you're still exposed to market-wide risks. If the entire sector or index your ETF is tracking takes a hit, your investment will too. Moreover, not all ETFs are created equal. Some ETFs track more volatile markets or use complex strategies, which can increase both potential gains and losses. So it's crucial to understand the specific ETF you're considering before you dive in. In a nutshell, ETFs give you the opportunity to invest in a broad range of assets without having to buy each one individually. They provide a balance of risk and reward, making them an appealing choice for both novice and experienced traders. ETFs can offer a versatile tool for diversifying your trading portfolio. And with that, you're one step closer to becoming a more informed trader. Let's delve deeper into trading gold and currencies. When it comes to trading, gold and currencies hold a special place. They are the pulse of the global economy, and their value can fluctuate dramatically based on a variety of factors. Let's break it down. Gold, often considered a safe haven in times of economic uncertainty, is influenced by factors such as geopolitical events, inflation, and changes in the US dollar. For instance, if inflation rises, the value of currency decreases, making gold more valuable. On the other hand, a strong US dollar often leads to lower gold prices as gold becomes more expensive in other currencies. Trading currencies, also known as forex trading, involves buying one currency while simultaneously selling another. The value of currencies is influenced by factors such as interest rates, economic growth, geopolitical risk, and trade flows. For example, if a country's interest rates rise, its currency generally strengthens as investors shift assets to that country to gain higher returns. So, how can traders profit from these fluctuations? In the world of gold trading, traders can buy gold when they predict the price will rise and sell when they expect it to fall. Traders can also use financial derivatives like futures and options to speculate on gold price movements without actually owning the gold. In forex trading, traders profit from the price difference between two currencies. If a trader believes that the euro will strengthen against the US dollar, they would buy euros and sell US dollars. If the euro does indeed strengthen, they could then sell the euros for more US dollars than they initially spent, thus making a profit. However, it's important to remember that trading, whether it's gold or currencies, involves risk. Prices can move rapidly in the opposite direction of your prediction, leading to potential losses. That's why it's important to have a well-thought-out trading strategy and to stay informed about global economic trends. When trading gold and currencies, It's crucial to stay informed about global economic trends. After all, knowledge is power in the world of trading. Have you ever heard of the S&P 500? If you have, great. If not, let's delve into it. The S&P 500, or Standard & Poor's 500, is a stock market index that tracks the performance of 500 of the largest companies listed on U.S. exchanges, like the New York Stock Exchange or the Nasdaq. Think of it as a barometer for the U.S. stock market, and to some extent, the U.S. economy. It's a weighted index, which means companies with a higher market value have a greater impact on the S&P 500's value. If you hear that the S&P 500 is up, it generally means that the largest U.S. stocks are performing well. Now, why is the S&P 500 significant? Well, it provides a broad snapshot of the U.S. stock market. It's widely accepted as the best single gauge of large-cap U.S. equities. Because it represents such a wide swath of the market, many investors look to the S&P 500 as a proxy for the entire U.S. stock market. You might be wondering, what are the benefits of trading in the S&P 500? For starters, it offers diversification. Instead of putting all your eggs in one basket, or in this case, one stock, you're spreading your investment across a collection of stocks. This can potentially reduce your risk, but remember, it doesn't eliminate it. Trading in the S&P 500 also allows you to participate in the growth of the largest U.S. companies without having to individually select and manage each stock. This can save you time and potentially increase your chances of success. But as with any investment, there are risks. The value of the S&P 500 can go down as well as up. Market volatility, economic downturns, and company-specific issues can negatively impact the S&P 500's value. So, it's important to understand these risks and manage your investments accordingly. In summary, the S&P 500 is a significant index in the stock market, offering a broad snapshot of the U.S. economy and the health of its largest companies. Trading in the S&P 500 offers potential benefits but also carries risks. As always, it's important to do your homework before diving in. The S&P 500 provides a broad snapshot of the U.S. stock market and is a key indicator of U.S. economic health. So, we've covered a lot of ground today. We embarked on an intriguing journey through the dynamic world of trading, where we delved into the fascinating intricacies of various financial instruments and markets. First, we started with the basics of trading. We learned that trading is not just about buying low and selling high, but it's also a strategic game of patience, meticulous analysis, and calculated risk. In this ever-evolving financial playground, it's important to stay informed and keep a keen eye on market trends. Next, we delved into the realm of exchange-traded funds, or ETFs. These are investment funds traded on stock exchanges, much like individual stocks. They offer a way to invest in a diverse range of assets without having to buy each one individually. ETFs can cater to a variety of investment strategies, from those that track specific indexes to those that focus on particular sectors or commodities. We also explored how one can trade the gold price and other currencies like the euro or the US dollar. Gold, traditionally seen as a safe haven in times of economic uncertainty, can be traded in various ways including ETFs, futures contracts, and physical gold. As for currencies, we learned about the world's largest financial market, the Forex or foreign exchange market. Trading in this market involves buying one currency while simultaneously selling another and making profit from the fluctuating exchange rates. Finally, we introduced the S&P 500, a stock market index that measures the performance of 500 of the largest companies listed on U.S. exchanges. Often used as a benchmark for the overall health of the U.S. stock market and the U.S. economy, it provides a broad snapshot of the market's performance at any given time. Investing in the S&P 500 can be done through index funds or ETFs, offering a way to gain exposure to a wide cross-section of the U.S. market with a single investment. This journey, though comprehensive, is just the tip of the iceberg. The world of trading is vast and complex, with numerous strategies, instruments, and markets to explore. The key is to start with a solid understanding of the basics, then gradually expand your knowledge and skills. Whether you're interested in trading ETFs, gold, currencies, or the S&P 500, remember that each of these markets comes with its own set of risks and rewards. It's important to thoroughly research and understand the markets you're interested in before diving in. Remember, successful trading requires knowledge, patience, and a keen eye for market trends. Stay informed, stay focused, and happy trading.